Kind of an interesting stat that I wanted to share with you this morning. The S&P 500, and we'll go over the numbers here in just a minute, but the S&P 500 finished up about 5 points yesterday to avoid losing ground for the first 3 days in April. And just to maybe give you an idea of how odd that would have been, going back to 1984, which is 40 years, the S&P 500 has lost ground on its first 3 days of April 2 times. 2001, 2002. Those are the only 2 years since 1984. So S&P had a little bit of a kick save, I guess, yesterday, avoiding joining those 2 years. Obviously, those 2 years were not good in the market, and I'm not saying the first 3 days of April determine your year, but it is odd. Last 40 years, only twice that we've seen that, and we barely avoided seeing it for the third time yesterday. Meanwhile, I looked to see how many times since 1984 we've seen all 3 days go up. And on the S&P 500, it's happened 10 times. So it's happened much, much more often. We do tend to get off to good, strong starts in April. And so this has been a little bit different. But of course, the first quarter was different as well, as we continued to push higher and higher, despite a few short-term warning signs, overbought conditions, and so forth. But anyway, I just thought that was a kind of an interesting stat. So I wanted to share that with everybody this morning. Initial jobless claims came out this morning, and they were a little bit higher than expected. We'll go over those numbers in just a bit, but the higher expectations signals maybe, because we've seen these, higher than expected readings before, but maybe things are slowing down a little bit in the economy. Maybe. I'm emphasizing maybe. Because I really don't think that's the case, but you got to recognize it. And anyway, the market actually liked it. So that news came out at 8:30, just about a half hour ago. And we've seen futures turn to the upside. They were already up, but they've added to it. So right now, let me give you those numbers for futures today. But right now, we've got the Spider up about 0.7%. The Diamonds up about 0.6%. The QQQ up 0.9, a little over 0.9%. QQQ up $4.12 back to 446. So not too far. I mean, 450, that area is our all-time high. And we had closed yesterday 442. So we've gotten half of it back this morning, getting back closer to that all-time high. IWM is up a little more than 0.8%, back up to 207.55. So we were just back down, just a couple of days ago, worrying about whether the trend line was going to hold 202, 201.5. That area, we were a little bit higher than that. We turned before we got down to that level, but we were down at, 203 and change probably before we saw a reversal yesterday, which was nice to see. We got a bullish engulfing candle on the IWM. But now we're getting that gap up, which is what I would expect after a bullish engulfing candlestick. Talked about this in our trading room yesterday. Or maybe it was in the daily market report, but I was hoping to see a strong finish at the end of the day, because if we did and we saw that bullish engulfing candle, that would have boded much better for today's open. And we did. We saw the action yesterday finish with a bullish engulfing candle on the IWM and some other areas of the market. And as a result, or at least partly as a result, we see the futures up this morning. But let's go ahead now and take a look at what happened yesterday in the market. And maybe that'll give us even more clues about what's going to take place today. Dow Jones Industrial Average yesterday finished down 43 points. I didn't look at the Dow, but that would be 3 straight losses on the Dow to open April. Maybe that's another project for another day. But Dow Jones down 43 points. S&P 500 up 5.68. So that was up just roughly 0.1%. But we skirted the dreaded 3 first days of April down syndrome. So that was good. Nasdaq 100 up 38 points. That was about 0.2%. And we finally saw some leadership come back into the mid caps and small caps. Mid caps gaining about 1/3% yesterday, while the small caps gained about 2/3%. Also, big reversal yesterday. And we talked about this before the open. We really wanted to see the transports rebound off of these moving averages that they're testing. And they did. Transports gained almost 0.75%. Moving on to the sectors, we had communication services leading to the upside, gaining almost 0.8%. Energy and materials can't kill them with a stick right now. Energy up another 2/3 of 1%. Materials up 3/5 of 1% or 6/10 of 1%. So both of those groups continuing their just tremendous uptrend, especially energy. Energy, this move now over the past 5 weeks or so has been almost parabolic. But that's fine. Energy, materials. Hey, everybody, let's go on for a ride. It's a bull market. Everybody participate. That's the way I look at it. So I love the fact that we're getting other groups that are participating in this. It leaves shorts with a big decision. It's like, where are you going to short? I mean, for a while, commodities weren't participating, so you kind of stay short in that group. Now they're on fire. I don't really know where you turn if you're on the short side trying to find, value or trying to find high reward to low risk trades. Not easy to see out there right now. Anyhow, aluminum continuing a big push to the upside. You can see after moving up earlier, about 2 or 3 weeks ago, mid March, we did pull back at that 20-day test and then back off to the races. And again, that's what I always talk about. I don't care what time frame you're looking at, look at that 20 period and the 50 period. When the 20 crosses that 50 to the upside, it's golden cross. When you go back down and you test that rising 20-day moving average and then break back up to a new high and you've gotten that golden cross, to me, there's not a much better signal than the prior sideways consolidation or maybe even prior downtrend has reversed. That's your sign. And so I think aluminum certainly shows you exactly what to look for in terms of that. We were going sideways. We broke back up above both moving averages. We got the golden cross. We tested the 20 and boom. You're looking at the transports over here. The 50 and the 20 have kind of been riding together because we've been going sideways for so long. Neither one's breaking away from the other one. But anyway, we went down, kind of tested both of them. Haven't made the breakout yet. And that's good. That's the thing we're looking for here with the transports, is getting off these moving averages and breaking out, seeing that 20-day break back up above that 50-day, and then the next pullback, holding the 20-day and taking off again. So transports aren't there yet. And this is a big part. I think there's a lot of folks watching the transports to get a better feel for whether or not they should trust this Dow breakout. Gets back to the Dow theory, which goes back many, many years. A lot of folks follow that. I believe in it. I think when you've got the Dow Jones moving up to new highs, you want those transportation stocks to confirm. And we haven't seen that yet. So transportation stocks, I would say if there's one area of this market that really hasn't yet shown a lot of bullishness, it's the transports. And if you think about the transports, what would send them higher? Higher economic growth. We want a strong economy, or at least a strengthening economy. As transports rise, that's what they're telling you. So we haven't gotten that. So everybody out there thinking that our economy is super strong, transports would say, I don't really agree with you. I think you're going to see this group break out, though. And when you do, I think it'll almost be like the last hurrah. Well, maybe not the last hurrah. That puts a little bit more bearish tone on it. But the last group seemingly finally joining the party, which would be bullish. Anyway, energy materials, you can see doing very well there. And then aluminum. Marine transportation up almost 3% yesterday. Another big move. This is another group been in an uptrend. Broke out of consolidation. Golden cross. Test of the 20 there. Test of the 20 here. Keep moving to new highs. Now, then you got the home construction. What the heck's going on here? Still looks bullish. I mean, we pulled back to the 20-day, but we had a nice day again yesterday, bouncing 1.5%. And we got the 10-year Treasury yield up close to its high for 2024 and for the last few years. I mean, with the exception of that one push up to 5%, I mean, we're still in an uptrend on the 10-year Treasury yield, and yet home builders continue to rise. Now, what that tells me is that the fact that the 10-year Treasury yield is up or has been rising has much more to do with inflation than it does with the economy. Because if the economy was so strong and we were worried about maybe getting too hot and inflation picking up further down the road, this is a group that with future higher rates down the road, this is a group that would not be performing well. And yet uptrend remains intact. So you got to look beyond the numbers, and you got to certainly look beyond all the media. Let the market tell you the story. Here's the news. I'm showing you a screen of the news. This is the news. Anyway, moving on, 10-year Treasury yield. So 10-year Treasury yield today down a little bit. That also is probably helping futures. And it's also probably because of the initial jobless claims out this morning, which was higher than expected, meaning that the economy is a little weaker, perhaps, maybe, like I said. Anyway, you got buyers in the bond market sending the yield down a little bit this morning. And that in turn is helping U.S. equities, which have struggled when we've been in these uptrends, these short-term uptrends in the 10-year Treasury yield. Generally, when that's happened, we've struggled a little bit more with stocks. That'll change, but at least for now, that's been the recent history. And so, last 3 days, we've closed down near lows on the 10-year Treasury yield. Maybe this breakout is only temporary. Maybe it's a false breakout. The measurement told us 466 is what to look for. But if you go back down, you break that cup, the top of the cup, you go back down below that, which is where we are right now this morning. And if you start to lose that 20-day moving average, pattern negated. So, I mean, patterns don't give us guarantees. Patterns give us an idea of what to look for. I love patterns because they do kind of help me zero in on a target, but they don't guarantee us that they're going up to that target. They don't guarantee us that they'll stop at that target. A lot of times that's the initial target and keep going higher. But in this case right now, we have to watch it because normally you get that breakout. Maybe you get a 20-day test, which right now on the 10-year yield is at 4.27%. So maybe we get down to there. But if you're counting on this pattern, you really don't want to see a 10-year Treasury yield close below 427. So keep an eye on that number. Moving on to the S&P 500. So there was the 2 days in a row to open April to the downside. Yesterday we were down early, but we came back into the close, and especially right at the close. You can see right here, we were down below 5,200. So we were in the red probably with about 30 minutes to go in the market, which would have been that third day in a row to start April. But we had some buying at the end of the day to negate that. NDX, Nasdaq 100, pretty similar, except we were down below the 20-day. Both of these two candles, by the way, losing the 20-day hasn't happened a lot. And when it has happened, you can see it really hasn't triggered a lot of selling. Here, I mean, we finished with a bearish candle back in mid-March below the 20-day. I mean, you would have thought, hey, we're going to continue going lower off of those three candles, and we didn't. And I'm going to try and do this to help everybody kind of see what I'm talking about. But right back in talking about back in the middle part of March, you'll see three candlesticks. And I know my cursor still doesn't show up very big. We've tried looking at some things here. At least I've tried quite a bit trying to figure out how to get that cursor bigger. I think a lot of it is just the way that everything gets configured, I guess, through StreamYard, which is the software that we're using. Because my cursor is as big as it can get. I can promise you. I've gone in and I've set it to the largest. On my screen, it's massive. But for whatever reason, it doesn't come through StreamYard. So anyway, maybe this will help. But these three candles in the middle of March, you can see going with the third one closing down below the green line, which is a 20-day EMA. That looked like we would probably go down and get a 50-day test. Next day, we gapped up right above everything. Went back up to a new all-time high. So even though I've been somewhat cautious, and I've talked about that over the last probably 3 weeks, 4 weeks, maybe even up to 6 weeks, going back to the middle of February when we did see actually a little bit of weakness. Usually the second half of the first quarter tends to be more of a struggle. And I wouldn't exactly say we've been flying, but we haven't really gotten hurt either. It's been mostly sideways with a little bit of a slant to the upside. But that's also one of the reasons why I say you can't fight a secular bull market. In other words, I might see some things that might bother me in the short term, and I might say, hey, I think the market has a chance we're going to get a pullback. You will never hear me say I'm going to short. Not going to happen. I will not short a secular bull market. Anybody who's been trying to short this market for the last 5 months probably knows what I mean by now. When a market gets going like this, you just don't short. I don't care what signals you see out there. You want to go to cash, okay. You might miss a little bit of upside. You might, if you want to move from aggressive stocks to defensive stocks, that actually makes a lot of sense. And we've seen a lot of value-oriented stocks do much better over the last 6 weeks than it's, say, technology or even communication services, which has done pretty well, and consumer discretionary. Those three key groups haven't really done that well the last 6 weeks, and we've seen that baton passed. It literally, a secular bull market is like a 4-person relay. In this case, maybe it's, I don't know, maybe it might not be 4-person, maybe it's 3-person, maybe it's 6-person, depending on how you look at it, whether you're looking at industry groups, sectors, whatever, asset classes. But what we've seen is technology pass that baton on to areas like energy and materials, which have been absolutely flying over the last month. Industrials, financials, they've been incredibly strong, showing great leadership. But the key is the money has not left the market. When the money leaves the market, you might see some of these value-oriented stocks outperform, but they're all going to go down. That's the difference. Even technology is not going down. We've had some pullbacks in a couple areas, but it's really not getting hit. It's just that when the market goes up, it's underperforming. It's been flat. Maybe it's down a little, maybe it's up a little, but hasn't performed as well as the S&P 500. But the S&P keeps going higher. We'll see whether or not this ends well or not, but I think we keep going higher. Let's move on to the IWM. There was that bullish engulfing candle. So again, let's zero in here. You should be able to see that right there. And it occurred right on the 20-day moving average. It also occurred just as this trend line was approached. We didn't quite hit it. I would say probably at 202.50 area, maybe 202, something like that. If you connect these lines, as I mentioned yesterday, I think, or maybe it was in the live trading room I did yesterday morning, trend lines, channel lines, and so forth, they're subjective. And what I mean by that is I like to connect candle bodies at, when I can. I like to connect where market makers are responsible either for opens or closes. If you're doing intraday, I mean, to me, sometimes the intraday is not, it's not going to last. We get the reversal off of it. And it doesn't show you a true picture of where market makers are allowing stocks to close. And so I prefer the closes and the opens just because those are more determined by market makers. I'm not taking my clues from retail traders. That's not what I'm going to take my clues from. I'm taking my clues from market makers whenever I can, because those market makers make money, and they make money at our expense. Anyhow, so anyway, channel lines can be very subjective, especially if you start connecting intraday moves. I mean, if I'm taking this low and this low, I'm going to have a channel line that comes way over here that hasn't been tested in a while and goes down much further. And if I, connect the highs, the intraday, I'd be connecting that one with this one. I don't know. The line would be that slope line would be going up much faster than this one, which would be flat, a little bit flatter. Anyway, I wouldn't be able to draw a channel. I like to get a parallel channel because that to me is a true trend. And when you get multiple tops and bottoms that connect to those channel lines, it just signals that the channel is more powerful in my mind because you've had more tests of it on the upside and the downside, and you continue to hold so that when it eventually does break one way or the other, it's more meaningful. And I believe we probably will break this channel. Believe it or not, I believe we'll probably break it to the downside eventually, just because the IWM is not going to go up at this rate every 3 months. It's just not from 187.50 to 212 or close to 212 in 2.5 months. That's not realistic to continue that kind of rate within this channel for an extended period of time. But we'll see how long it lasts. For now, it's holding. And again, we got that bullish engulfing candle, which suggests higher prices today. If we open up like the futures are showing, as far as I'm concerned, this candle is 100% correct. Even if we gap up and sell off all day long and go to new lows, I will say that candlestick worked, because the candlesticks, these 1 day reversing candlesticks are not predicting the next 6 months in the market. They're a short-term market inefficiency indicator, telling you that we went down probably too far. We got the reversal. Market makers are probably long. And so we're likely to see higher prices in the near term, which would be, to me, one candle. That's all it takes. Now, if you have other corroborating indicators to go along with that candlestick, then yes, it could be a much more significant bottom. In this case, we didn't quite test that channel line, but we were close. We did reverse on the 20-day moving average, which we know over the past 5 or 6 months, that's been a big deal. The 20-day moving average has been great support on many areas. So having a reversing candle at the 20-day, to me, does give me a little bit more of a bullish feeling than just a random bullish engulfing candle off of a downtrend that just occurs some random place on the chart. I would still look for the reversal, but this one, like I said, because we're coming off the 20-day, maybe gives me just a little bit more of a feeling that we're going higher. Transports, here was that bounce I was talking about. So again, let's zero in here. Right off of the 20 and 50-day moving average. Big reversal back to the upside. Now we have higher highs, higher lows. We'll see. I imagine we're going to gap up with the overall market. Can we finally get up here and take out about 16,250? Please. I'm almost begging. Yeah, transports again. I'd like to see transports performing well. So 16,250 is a level we should be watching there. All right. Head over to earningsbeats.com. Always an invitation open. We do have a 4-part education series. You can read about that. You can become a 30-day trial member that covers all 4 of these. They come up on Mondays in April. So the next one will be this Monday. We'll talk about price volume at 4:30 p.m. Eastern time. Then on the 15th, also at 4:30 Eastern, we will talk about divergences and how I use divergences, what divergences mean, what we should expect. They are not guarantees. So I can give you a couple of examples of when they don't work, or sometimes when I tend to ignore them. That's on the 15th. And then the 22nd will be our 4th in this series, talking about trading gaps. And that one is near and dear to my heart. As probably all of you Earnings Beats members know, we do a lot of work in terms of putting together chart lists and so forth. And I do a lot of trading around gaps involving earnings usually. Those 4 events, we've already done candlesticks, which was last Monday. Recording is available on our website to our members. But you've got these 3 coming up. So make sure you go in, sign up for your 30-day free trial, and check out that education coming up the next 3 weeks. Next, if you haven't done it, I don't know why, sign up for the EB Digest. This is our free community. No credit card required. You can unsubscribe at any time. I think we put out great information, valuable information. Name and email address is all it takes. So hit that subscribe button and we'll have you set up. So for today, for a chart of the day, what I wanted to show you really was just the last month. You can see 1 month period up here on the left side. And then I've got all of these different groups listed as the best industry group relative performers over the last month. And so let's zero in and take a look at these, because this has been a period last month, like I said earlier, money's rotated out of areas like technology and consumer discretionary, but the market is held up, and it's because technology and consumer discretionary are not really going down, or if they are, not much on a relative or on an absolute basis, but on a relative basis, they are, because other areas now are leading the market. And so it's kind of like, trying to run a marathon, but you didn't really practice for it. And so you got to take stops, probably a lot of them along the way, but you got to pause for a little while, catch your breath, and then get going again. That's what I feel like technology and consumer discretionary, and to maybe a limited extent, the communication services group. It's kind of what those 3 groups to me have been doing for quite a while now, well, a month, is that they're just kind of settling back a little bit, taking a break from this long, long journey they've been on. And I fully expect they're going to start running again soon. When, I don't know. But in the meantime, the money's not leaving the market. We are seeing strength. These are the top, what do we got here? 5, 8, 11. These are the top 11 groups, industry groups over the last month, starting with aluminum. You can see the industry group, or excuse me, the sector that they're in, because all of the material sectors, all the industry groups within that sector, I start off with 011. Then I type in XLB, and then I number from 1 to however many industry groups are within that individual sector. And then I show you the ticker versus the S&P 500. The one that I have, I think there's another one that I have where I actually write out to the side aluminum, non-ferrous materials. It might be in the one that I've included on our website for our members. But anyway, you can see aluminum, non-ferrous metals. You've got gold mining. These are groups that I'm not big fans of long-term, but hey, they get their time in the sun short-term as well, and they're in it right now. You got exploration, production stocks in the energy group here. Top 5, materials and energy. Then you look down, you see discretionary, another energy, industrials, energy, industrials, financials, industrials, utilities. Where's technology? There is that one discretionary there, but where's technology? Where's the rest of discretionary? Where's communication services? I mean, I've gone now down through the top. I guess this is like 12 or 13. 5, 8, or no, 5, 10. Yeah, 13, 14, consumer staples, 15, energy, 16, finally, we get into some aggressive areas, internet, 17, banking making a move, but it's been mostly large cap. Still waiting on the small cap banks. I still believe we're going to see them. But when you look at banks, don't think small cap because it's been mostly the big ones that have been rolling. But again, you can just kind of get a sense. Where's the technology? I mean, how far do we go down to find a technology group? Let's just take it one at a. There it is. And it's renewable energy, which has not been strong for the last year, but starting to show more and more strength. So the market's kind of flipped on its head for the last month. Things that weren't leading on a relative basis are leading, and everything that was leading is not. That's what's called bullish rotation. And it's a hallmark of secular bull markets. Yeah, I don't really know what else to say. We got a minute before the open, though. Let's take a look at. I finished the show a minute early. I feel like I need like standing ovation or something. I can't remember the last time that I looked up and I was done, and it was 9:29. Anyway, I see? I don't even know what to do. I don't even know what to look at this point. I can tell you that Ulta yesterday, and members were telling me this in the live trading room. You know, there's one downside to me not liking to follow media is that a lot of times I don't hear the news as quickly as a lot of other folks. And so I'll see a stock and I'll be like, oh, wow, that stock's getting hit pretty hard. And then I have to go look for the news. But anyway, members were providing me that information yesterday during the trading room. So apparently Ulta lowered its guidance to the lower end of its previous range. And as a result, Ulta, you can see, got hit really hard, down 15% yesterday. And we also saw ELF, which is kind of in the similar type area. ELF Beauty also taking a big hit, moving down below its moving averages, although market has opened. We are seeing a little bit of a bounce back there in that stock. But let's take a quick look on this chart, on a 5-minute chart. We'll take a look at the major indices. So we got the diamonds tracking the Dow up 0.7%. The spider is up 7.76. That's roughly 0.75%. The QQQ up a little more than 0.9%, and the small cap IWM up 1.21%. So getting our strength there back above the 208.21 level. Now, I'm not really paying attention to that. That was where we needed to get the breakout originally when we went up to about 211 and change. Came back down. I was looking to hold that 208.21 level. That was the first level of support, didn't hold. Anyway, right now we're trading back above that, so that's good news. Let's see what the VIX is doing here. VIX is down 2%, back to 14. Seems like we're right back into bull market mode. I don't know whether we break out, whether this lasts, but we do have a huge non-farm payrolls report tomorrow. And based on the way the stock market and the bond market have been trading, if that jobs number comes in much higher than expected, I would expect yields to go right back up to new highs. And I would think that we would see some red futures or things turn red. I think if the jobs report comes in at expectation or below, especially if it's, I don't want to see negative jobs. I think that would be kind of a shock. But I wouldn't mind seeing positive jobs just below expectations or right around expectations, which I think would leave the Fed right on course for what it wants to do, which is lower rates later this year. The other thing I would say in leaving here is I know a lot of folks excited about commodities right now. It happens from time to time. We do get these surges periodically. What I would ask you to do is whatever commodity you're looking at, look at it relative to the S&P 500 and pull up about a 15-year chart. Because even though we're seeing a lot of absolute strength, it's really a blip on the radar. We are definitely starting to see a little bit of movement to the upside on that long-term relative chart. Because again, for me, it's all about, I want to see areas that are trending higher relative to the S&P 500, not occasionally bouncing higher. It's a big difference. Take a look at those charts, especially gold, silver. Yes, they're on fire right now. Everybody's getting really excited. Just make sure you keep I would have a trailing stop in play. And the reason I would have that trailing stop in play is that 15-year chart I want you to look at. Again, whatever commodity you're looking at, if you have one that's looking really good on a relative basis and has been for a year or more, send me a comment at support@earningsbeats.com because I'd like to take a look at it. But for the most part, the ones I like to follow, not really seeing it. We are getting a really good move though in copper, which is exciting because the long-term relationship between copper and global stock market indices is positive correlation. So I always like to see copper going up because copper is the one metal that is used across all industrial nations. I mean, to me, copper is the big one, not gold, not silver, copper. And when copper gets going, it's telling us that there's demand, not because somebody's hedging, or it's demand because of global economic activity. So copper breaking out and moving higher really gets me excited. And right now or at least recently, we have been seeing copper moving up quite a bit. Anyway, that's it for me. Last show of the week. Want to wish everybody a great rest of your week. Enjoy your weekend, relax. 1 week from today, I should have worn my Masters hat, but it probably wouldn't have matched very well. But 1 week from today, the Masters. I'm a huge golf nut, and I love the Masters, my favorite weekend of the year. I love spring, all of it coming together next Thursday. So I'm getting more and more excited about that. But anyway, have a great rest of your day and your weekend, everybody. Happy trading.